So GP stakes investing. This is investing in minority ownership of private equity firms, which are some of the greatest businesses ever created. What this means, this diagram here, we are on the right-hand side, the green box, we are making an investment into a general partnership of a private equity firm. And typically we're doing this over a bunch of different firms. In the past, it's been up to 60 different investments into a wide range of general partnerships, including real estate private equity firms, infrastructure, private credit, and then just private equity, which is buying private companies, improving them, selling them in 3 to 5 years, and generating outsized returns relative to stocks and bonds. And historically, those returns have been mid to high teens, which have been stellar returns and have made the general partnerships, the owners of these private equity firms, extremely wealthy. And we get to participate in that wealth creation by writing a check for 10 to 20% ownership in these various private equity companies. Then we get to participate from the management fees and the promoted interest, the profits of their investments. And these are not no-name private equity firms you've never heard of that are extremely small and under the radar. These are some of the largest private equity firms in the world. Here's a list of some example firms that we have personally invested in, some of our clients have invested. And so you can see here you have several $100 billion plus assets under management firms. These are some of the best in the industry here. CDC, which is the largest private equity firm in Europe. Relied Capital, which is a giant private credit asset manager. HIG, Cerberus, Clear Lake, Starwood Capital, which is a real estate private equity firm. Veritas Capital tends to focus on government contracts. Vista, which concentrates on large software purchases. Once again, extremely successful, large private equity firms with multiple different funds across multiple vintages. This is a unique way to enter into private equity. You're not just investing in one fund or one private equity investment. You are investing in a pool of private equity managers who also own a series of private equity funds. So this is the most diversified way I can think of to get exposure to private equity and sit on the same side as the owners, the extremely wealthy, and sit on the same side as the private equity partners, which is a great place to be because, once again, they're using other limited partners' capital to go out and buy companies or make investments in real estate or private credit. And then we get a piece of those management fees and the promoted profits and the balance sheet returns, which are the private equity firms' investment in their funds. We get a piece of those as well. So it's a very unique way to enter the space once again. So just to reiterate that, we are side by side with the partners of these firms. We are getting our cash flow, which typically is double digits, which is pretty rare to get that type of cash flow, but it's high cash flow because of management fees, the carried interest that we talked about, and the balance sheet returns, which are the investments that the general partnership has made into their various funds that we get a piece of those returns as well. So there's 3 different streams, 3 different buckets that we can use to get those double-digit returns. And the best of those is the management fees, which are contractual in nature and often will go out 5 to 10 years, depending on the length of the underlying fund. And so it's not in doubt whether or not we're going to be getting that revenue. These are contractual agreements with large, giant, limited partners like endowments, pension funds. They don't make a habit of missing payments. They have hundreds of billions of assets of their own, so they have plenty of capital to pay the underlying management fees of each of these funds that we are once again participating in. All right, and the great thing is we have a lot of tailwinds too. In order for these private firms to grow their assets under management, get new capital, which is going to increase our management fees and our potential returns on profits, which is a great thing. We've seen this giant increase in private assets as a percentage of total. We've seen this giant increase in assets under management for these private equity firms, and we believe this is going to continue to grow. The private market is taking away market share from the public market as there's fewer companies that are going public today. They're staying private longer. Investors really enjoy the lower volatility of private equity returns just because they're not marking them to market every day like your stock, which moves around on a minute-to-minute basis, whereas private equity returns are much smoother in nature because they are getting evaluated quarterly, which is just a much more comfortable ride for the limited partners, the investors, and hence why some of these assets have grown so much, in addition to their stellar overall performance. And really, while this is a lot of growth, this is just the beginning. As you can see here in the graph, private credit, real assets, includes real estate, infrastructure, and private equity as a percentage of the global wealth is still quite small. So most of the global wealth is, once again, in bonds, in various stock markets, and it's in public assets, and not in these three different strategies, which is the vast majority of the firms that we end up investing in focus on one of these three strategies. So as a percentage of the overall market, there is a lot of room for growth, which means more management fees and potential profits for us. All right, so to give you a quick recap of our short overview here, we love this sector. We love investing in GP stakes because of the attractive recurring revenue nature of the management fees. We're investing in one of the best business models in the world, a private equity manager where you're using other people's money to make high return investments. We get to participate in those returns. Typically 20% of the profits go to the general partnership, which we're a part of. We're investing with some of the best private equity firms in the world who love this capital because it helps them with their succession planning, helps them get into new investment products, helps them make introductions to new limited partners. So that everybody wins in this structure. And then finally, we get a ton of diversification by investing in not just one fund with one manager. We're investing in a ton of different managers. So we're getting diversification not only with those various managers, but then also with their underlying funds, because most of these managers have 5+ funds that they currently manage that we're getting exposure to. So this is a very unique way to get exposure to private equity. I think it's probably the best way for a high net worth investor to get exposure to the space because we're sitting on the side of the general partners in the firm who have made tremendous wealth because they're very good at this. And it's a unique way to generate alpha by investing in private markets where there's still an information advantage versus the public markets where it's more difficult to generate alpha. And then we love investing in industries where there's a lot of tailwinds. And as we talked about 2 slides ago, we think there's a ton of growth in this industry as more and more limited partners get access and increase their portfolio allocation to private markets. So if you'd like any more info, feel free to reach out. We're here as a resource for you. info@evergreencap.com.